welcome to this morning's webinar on small business succession planning. My name is Chris Cooper. I work at the Ohio Employee Ownership Center at Kent State University here in Ohio. Today's webinar is on transferring a business through gifting and trust. And we have as our presenter today Tom Gilbride, who has been a practitioner doing these types of things a lot, and has also come at it from the opposite end. One of the things that Tom also does is he does a lot of continuing education training for professionals. So not only has he practiced what he's teaching here today, but he's also taught it. And so I've known Tom for a little while now, and very knowledgeable, and explains things in a easy to understand way for the average person. So very pleased to have Tom here today. And I think without further ado, I'll turn it right over to you, Tom.
Okay, well, thank you, Chris. Good morning, gentlemen. I will start the presentation here, and then I assume if other people join us, Chris will handle all those kinds of things. But I'm going to advance the slides to the into the background section, and kind of walk you through this whole business of gifting and trusts, and what some of the benefits are and why people choose to do these things. So. Chris is going to be kind of the coordinator, so if you have questions or want to ask something along the way, I think you'll be in a position to do that through either through the website or just by unmuting your phone and asking Chris. But in any case, the slide that I'm on right now is ask the question, what is gifting? And gifting is the gratuitous transfer of money or property from one person to another. So whenever you gift something to somebody, they don't give you anything back for it. Unlike a sale, there's not consideration given for it. So generally, any person is free to gift any money or property that they own to any other person, including family and any other parties as well. The one other caveat to that would be that people who have employees can't really make gifts quite as easily to employees. If you're gifting money or property to an employee, that's generally considered compensation, and it's taxable income to the employee. So when you're talking about business succession planning, that kind of gets a little bit complicated, and we'll talk about how that's done. Second bullet point there is often gifting is used in business succession and estate planning. And the reason it's done is in the third bullet point, it can be used to create a number of desirable tax, economic, and practical benefits. So some combination of those tax, economic, and practical benefits are the motivation for the particular party to engage in these activities. The next slide. What is a trust? These are the two items we're talking about here. A trust is a legal entity. It's a device that's generally created by declaration. So there are state laws and federal laws that govern trusts, and those laws mandate that certain conditions have to, certain characteristics have to be present in the trust, which is a written document, in order for it to qualify as a trust. But generally, to set it up, a person simply declares it to be come into existence. So you do that in writing. You make a declaration on the first page of the document and say you create this trust under the name of such and so on. So fairly easy to do. Unlike forming a corporation or a limited liability company where you have to apply to the Secretary of State in a given jurisdiction, you simply do this as a matter of your own will. Often, again, trusts are used in business and succession planning for the same reasons that gifting is employed. There are a number of desirable tax, economic, and practical benefits that can be created by using the trusts. So gifting and trusts are part and parcel of business succession and estate planning, and they're used oftentimes, in some cases they're used independently, in other cases they're used in combination. So part of this, the subject matter is, what is, we're going to talk about succession planning, so what is that? So I'll just read this definition real quickly. Succession planning is a plan that provides for the transfer of operating control and ownership interests in a business. The business in question is usually a privately held or a family-owned business, and then equity and control can be transferred independent of one another at the same time or at different times. So sometimes parents, for instance, who own a business may choose to transfer some of the equity in the business to their children, but want to maintain control, 100% control. So there are ways to do that, and you can accomplish that objective if, in fact, that is the objective of the parents. Sometimes interest transfer during the lifetime of the owners. In other cases, it transfers at their death, or some of it transfers during lifetime and some of it transfers at death. So in any case, that's basically what succession planning is. And then what is estate planning? Again, I'll read this. A plan that provides for the outright transfer of one person's assets to other parties during the lifetime of the property owner or after the property owner's demise. Property can be held, usually in trust, for the benefit of estate beneficiaries as an alternative to an outright transfer. Generally, such a plan also attempts to minimize the costs and taxes associated with the transfer of property. So estate planning just basically says at some point in time, I'm not going to be around anymore, but my assets will likely survive me. So who becomes the owner of those assets, either after I no longer need to own them all during my lifetime or certainly after my death? So estate planning deals with an orderly transfer of those assets with a corollary objective of attempting to minimize taxes and costs. Now, a partnership of sorts, as I indicated before, oftentimes gifting and trust are used in combination to create these desirable tax economic and to create these benefits that I mentioned earlier, tax economic and practical benefits. Again, they lend themselves to these things. So often these are done in concert. You can do succession planning and estate planning independent of one another, but generally speaking, they're done in combination. Simultaneously. Both elements are an integral part of a succession / estate plan. Now, one of the big considerations that comes up in an exercise where a business owner is considering these things are the tax implications. And there's a large number of tax implications that present themselves. So I'm going to kind of go through these things. I'll spend a little bit of time on this slide. I'm going to assume you don't know a whole lot about these things and try to give you an explanation. But we have in the United States what could be called a unified transfer tax mechanism or arrangement. So people choose to transfer their money and their assets in some cases during their lifetime, and when they make these transfers without consideration during their lifetime, we call them gifts. If people transfer their property after their death through their estate plan, we call those transfers bequests. In some cases, a transfer of property during one's lifetime is taxable. Or I should say, actually, that all transfers that are gifts during one's lifetime are taxable events. So there are tax implications that you need to know about. And likewise, the transfers that occur after death are subject to taxes as well. Where you pay tax on a gift during your lifetime, we call that a gift tax. And where your estate pays taxes on your assets when they transfer after your death, we call that an estate tax. If someone wanted to calculate these taxes, you would calculate them off the same tax table. So we're using the same tax table and tax system to tax these transfers where, again, they're subject to taxation. So, for instance, the tax law basically says that if you choose to transfer money or property during your lifetime, any person can transfer up to $13,000 of assets a year to any number of people. So if you had 3 kids, you could make a $13,000 gift to each of your children and it wouldn't be taxable. If you were married, you could join with your spouse and make a $26,000 gift each year to each of your children. But it's not limited to your children. Other than the caveat I gave you earlier with employees, you could give this property to an unlimited number of people. And that item is called the annual gift exclusion, and it tends to go up in value each year. This year it's $13,000. It ratchets up by an inflation indicator. Given the level of inflation we have right now, it probably won't go up next year, but nonetheless it's $13,000 this year. There's also another gift tax item that's called the lifetime exclusion. And in the lifetime exclusion, you have a $1 million exclusion for gift tax purposes. So you have two items here. You can give away $13,000 a year to any number of people year after year. And in addition to that, during your lifetime, you could also give away $1 million under this exemption, either in one event or a series of events that add up to $1 million. So you have these two essentially exemptions to work with, and there are different rules that apply to each of them. To the extent that you haven't gifted away all your property and assets during your lifetime and they transfer through your estate, then you would be subject to estate taxes under the current law. If you had an estate that was larger than $3.5 million, as many business owners do, then there would be federal taxes to be paid above that level on the assets in the estate. If you're married and you set your estate plan up correctly, then you can double that to $7 million. Now, I'll come back to these taxes later because things are likely to change here, but those are the rules that apply this year. So both transfers that are made during lifetime as well as those that are made after death are subject to taxes above the exemption levels. So part of the trick is to for people to fully utilize these exemptions, and to the extent possible, even leverage them. Now, I see I have a question here, so I can stop, and if Chris can navigate this thing, I can take the question now.
Just a quick question on the 13,000 and the million. If you're gifting 13,000 or 26,000 for a married couple on an annual basis, does that gift also contribute to the $1 million? The $1 million?
No.
Okay.
Does it reduce the million?
Right.
No.
Okay. Thank you.
No, they're renewable each year, and they're two separate items, so one doesn't affect the other.
Thank you.
Okay. Okay, so in any case, using these gifts creates some of the benefits that I talked about earlier. Now, there's another tax for people who are very wealthy called the generation skipping tax that comes into play. And basically, generation skipping is an old idea where somebody figured out if I can, if I'm worth $100 million, let's say, and my kids can live comfortably on $50 million, maybe I'll leave $50 million to my kids and the other $50 million to my grandchildren. And then basically, if your kids leave their assets to their grandchildren and your grandchildren leave their assets to their grandchildren, you're skipping a round of taxation in every other generation. So if you put a pencil to that and do the numbers, that saves a wealthy family a lot of money on a generational basis. Well, the tax law says you can do that, but there's a limit. And basically, grandparents can fund, have an exemption. It's roughly $1,020,000 in one event for their grandchildren. Now, if you exceed that $1,020,000 lifetime gift to your grandchildren, and this is a third item. It's in addition to the 13 a year. It's in addition to the $1 million lifetime. If you exceed that $1,020,000, then there's a tax called the generation skipping tax that comes into play and continues to tax those assets generation after generation. So great care has to be taken to avoid the generation skipping tax. Now, when you fund the generation skipping exemption, however, you are using your $1 million or a part of your $1 million that I mentioned before to fund that. So it gets a little bit complicated, but it's an element that you need to be aware of. depending upon the level of wealth being transferred, the generation skipping tax may come into play. Okay, now, in addition, depending upon where you live, there may be state death taxes that have to be paid as well. We're in Ohio. Ohio has a state death tax that applies to transfers of property through an estate. However, there are no gift tax issues as far as the state of Ohio is concerned. But as I said, there is a death tax. Other states have what's called an inheritance tax. An inheritance tax means the tax is paid by the heir who inherits the property. An estate tax is a tax that means the estate of the deceased person pays the tax. And then 2 states have both of those taxes. New Jersey and Maryland have both state death taxes and state inheritance taxes, so they double dip in those states. And then there are other jurisdictions like Florida that have no taxes whatsoever. So the state death taxes, where business owners are concerned, come into play as well, and you have to look at the jurisdictions that are in play as well. Now, there are capital gains tax issues that have to be considered as well. When someone owns a business or other assets, and they can give them away, as we've said, but they can also sell them. And sometimes business owners choose to sell their assets to their children or their business to their children rather than give it to them, or they choose to sell a portion of it to them. And there's a variety of reasons that they might do that. Some of it might simply be a means of raising some cash that they need, but that's a capital gains tax event. So part of the cost of doing that is you have to pay capital gains taxes. When you make a gift, you don't have to pay capital gains taxes. However, when you do make a gift, the basis in the asset moves with the gift. So if mom and dad start a business and they put 10 grand into it to start it, and then the business is worth $1 million at some point, without getting into all the technical issues of the math, they've got a $990,000 gain. Well, if you make a gift of your business, your $1 million business, under your $1 million exclusion to your children, then the original $10,000 basis moves with it. So if your kids ever sell that business, their basis is $10,000, and they have to pay the capital gains tax in the next generation. But you didn't have to do anything in your generation as far as capital gains taxes. Now, there's also another item called transfer of basis stepped up cost basis. And what that means is if you take your $1 million business that you originally capitalized for $10,000 and you transfer it through your estate, the $10,000 basis steps up to the date of death value, dollars in my example. So that means your kids inherit the property and their basis is $1 million, not $10,000. And should they sell it quickly, they would have no capital gain. And if they hold on to it for a while before they sell it, they'd certainly have less of a capital gain. They would benefit from stepped up cost basis. So when you make gifts, you don't get any step up in cost basis. So that's a negative. When you transfer assets through your estate, you get a stepped up cost basis. That's a positive. But so one of the issues that comes up is balancing all of these things. Where's the greater benefit and what are the downsides of these various transfers? So obviously you need a good practitioner in the loop, good tax practitioner in the loop who understands this and can do the math on all of these things. And then finally there's income tax considerations. If I'm collecting distributions from a successful business in the form of S distributions or some such thing, I pay income taxes on those things, and sometimes I might pay income taxes and then turn around and give some of that after-tax money to my children as a gift. Well, if I give them some of the business, they'll get the distributions, and if they're in a lower income tax bracket than I'm in, then we're paying less tax on those dollars, those same dollars. And likewise, the same thing would hold true at the state income tax level as well. So although the business owner is, or the family is not thinking of these things, that's the role that one or more of the advisors are playing, is to have an appreciation for the impact of the benefits, the tax benefits, and as I said before, to balance them. So all of those things have to come into play as well. Now, if we go to the next, oops, I clicked the wrong button here. Okay, next slide. The economic considerations. It's fairly easy. The net result of this exercise should be that there's a lot of money that's being saved. Now, much of the money that's being saved are taxes. We're minimizing taxes where we can, and avoiding taxes entirely if that's possible. And the savings either end up in the pocket of let's say, the parents or the current generation of owners, and or in the pockets of the heirs or the next generation of owners. So the net result of this activity should be that less assets are lost to the family, and it's principally, as I said, through tax benefits. Okay, practical considerations. Sometimes in a family business, the parents simply have an objective of providing some benefit to their children. So if I have an S corporation or an LLC and it's successful, again, if I give some of the interest to my children, they'll start to get distributions, and they can have some use and enjoyment of the success of the business right along with me. So it could be that simple. They're simply trying to provide some kind of a benefit to other parties. In other cases, it's a demonstration of good faith. The parents tell their children who perhaps work in the business with them that someday this business will be yours. And the parents are 80 years old, and nothing is transferred yet, and the children are 50 years old or 55 years old. So sometimes, as a demonstration of good faith, transferring an interest in a business is done for simply that reason, to say, yes, I said you were going to be an owner, and you are an owner, and so on. And doing this planning and bringing the children into the process also is a demonstration of good faith. They see that a plan is actually being put into place that's going to transfer the business and the economic benefits and so on. Sometimes this planning is done in order for the parents or the current generation of owners to continue to exercise control over the asset. So they want to start to transfer equity or maybe even transfer income, but they want to maintain 100% control or a majority interest or some such thing. So again, this is where perhaps trusts come in. Trusts, among other things, provide control for the assets that are in the trust. Also, one of the practical considerations is to provide expertise. When you transfer assets, including businesses to children, they may not have the skill level or expertise required to operate that business, and third parties may have to be brought in through the trust to provide some assistance to the business. You could avoid, and you don't necessarily have to use a trust to provide expertise to the business, but oftentimes it is done through the trust. You avoid burdening your heirs with the necessity of managing a particular asset. Again, it may be time-consuming and overall a burden for the family members, so you provide a third party to do this. And then oftentimes people who use these strategies want to maintain the asset in its current form. Now, in my seminars, I typically use the example of the family farm as an asset that sometimes people want to see it remain in the family generation after generation, so the family can benefit from it as a family gathering place or whatever. But likewise, it could be a business interest as well. But again, those 4 bullet points, those last 4 bullet points, to exercise and control, providing expertise, not burdening your family, and maintaining an asset in its current form are typically benefits that are derived by using a trust. Now, kinds of gifts. Gifts have characteristics associated with them that are important to understand. And one type of a gift is an outright gift. And that means that the donee, the party who receives the gift, has control and discretion over the gift. So if I give my children one of my children $13,000 this year under my $13,000 annual exclusion, that child is free to do whatever he or she chooses with that money. It's entirely under their control, no strings attached. There are other instances where you make a gift that has limited discretion and control. So I'm going to give you these assets, but I'm going to restrict your use and enjoyment of these assets. So I'm going to give you some stock in the family business, but I'm going to put it into a trust, and you're the beneficial owner, which means you have all the most of the rights of ownership, but you don't have the right to vote the shares, for instance. So that could be done for a practical reason, or it could be done because the parent simply has a problem giving up control. But when you do that, you get into two other issues, which are the next two items. Gifts are either considered under the tax law to be gifts of a present interest, which means that the donee has the immediate use and enjoyment of the gift, going back to that outright gift idea earlier. The tax law goes on to state that if you don't give the donee the immediate use and enjoyment of the gift, then that's classified or considered a future interest gift. So a future interest gift means that I don't have absolute control or discretion over the assets, so some of the use and enjoyment of this asset has been deferred. And that the implication there is that future interest gifts do not qualify for the $13,000 annual exclusion, or what I call the annual giveaway. So if I'm going to start to give $13,000 a year to one of my children, but put it in trust and restrict his control, that has to go against my $1 million, my lifetime gift, and I have to subtract $13,000 from the $1 million because it's not a present interest gift. So these are other nuances and implications that one has to understand and be cognizant of when you're doing these things, so you understand the implications that come into play. So again, these are some of the characteristics of gifts. So why would someone want to gift? And again, to give the donee use and enjoyment of the asset, to demonstrate good faith, to remove the asset from the taxable estate of the donor. So among the motives that a donor might have is I have an asset that's appreciating in value, and I think it's going to continue to appreciate in value in the future, and the more valuable it becomes, the more costly it will become from a death tax point of view to transfer it to my heirs. So if I get rid of it today, I'm getting some of the appreciation on this asset out of my taxable estate. So again, that would be the reason. And again, the fourth point there, to remove an appreciating asset from one's estate. There's also an item called a freeze, where you freeze the value of an asset at today's value. And that's done through various gifting techniques or sales techniques. I'll come back to this a little bit later, but as a simple example, if I have a business that's appreciating in value, let's say at 10% or 20% a year, I know it's going to be very costly to transfer that asset to my children. So what I do is I sell it to my children today on an installment basis. So I sell them my business for $10 million, and they agree to pay me off on an installment basis over, let's say, 10 or 15 years. At that point, I no longer own a business that's appreciating in value. I own a note that's fixed in value. So effectively, I've frozen the value of my business at today's value or the original value of the note. So that's an example of a freeze. But there are other ways of freezing the value of an asset for tax purposes as well, as I'll discuss in a few minutes. The second to last bullet point, to lower the overall transfer tax burden to the family. If I give away $13,000 a year, year after year, to a reasonably large number of people, and then if I'm married and my spouse joins with me in those gifts, over a 10 or a 20-year period, you can give away a great deal of money. And those assets are gone. They're out of your estate, and you never have to worry about them being taxed in your estate. So you're lowering the ultimate tax liability associated with transferring those assets to ultimately to your heirs. On the other hand, if you make a gift of $1 million with the idea that you're going to lower your overall tax burden, that works differently. And let me see, I'll try to walk through this simply. Whenever you make a gift of the $1 million during your lifetime, that's an event that requires you file a tax return, a gift tax return, and you file that in April when you file your income taxes. And you're basically putting the IRS on notice that you used some of your $1 million or all of your $1 million during your lifetime to transfer an asset. At the time of your death, your executor has to fill out an estate tax return. And one of the items that the estate tax return asks is, did the decedent make any gifts during his or her lifetime? Now, the executor is supposed to know that you did this, and if he or she doesn't, the IRS does. So in any case, I believe it's line G on the form, and what you basically, the executor says is, yes, $1 million gift was made during the decedent's lifetime. So the executor has to take that $1 million and add it back into your taxable estate as though you never gave it away, and effectively tax it then. Now, somebody might say, well, gee, that doesn't seem to make sense. Why in the world would I give it away during my lifetime and now I have to put it back in my estate? What did I accomplish? And the answer is you accomplished a freeze. When you gave it away and filed the tax return, you froze its taxable value at the value for that particular date. And if it appreciates in value between the time you made the gift and the time you die, all that appreciation's out of your estate. But you really didn't give it away. The only time you really give assets away that never come back into your estate is by using the $13,000 annual exclusion. So again, it gets a little bit complicated here, but again, that's why you need advisors in these kinds of transactions. And then the last bullet point there is, you may choose to move taxable income to family members in a lower income tax bracket. So if I'm taking S distributions and I'm paying taxes at 35 or 38% to the feds and everybody else on top of that, then I would transfer these assets by gift, and maybe my kids are in a 25% tax bracket, and there would be a lower amount of taxes paid on those assets. Okay, why use a trust? Okay, in general, trust can be used to provide control over the beneficiary's use of assets, as I said. Further, trust can provide management. Again, these are the four items I mentioned earlier. Trust is used for control, management, maintenance, preserving an assets in its own form, and to lower overall transfer costs. A trust can also provide for the maintenance of an asset. Finally, using a trust can reduce transfer costs and eliminate taxes. So there are a variety of uses for trust, including hopefully the lowering of estate taxes that might present themselves. Lifetime transfers. A lifetime transfer takes place, and where this is lifetime transfers take place where there is an interest during the lifetime of a business owner to take advantage of a benefit that can be realized by transferring an interest in a business either in part or in its entirety. So why would I transfer any of my business during my lifetime? I'm going to get some benefit out of it. Now again, the transfer can either be a sale or a gift. There are advantages to each of them. Very often, though, gifting is used instead of selling an asset because, again, there are tax implications to a sale. Gifting can be, tax-free. Post-mortem transfers, here either none of the business has been transferred or the transfer is not complete and has to be transferred at the death of the owner. And again, an estate can be instructed to simply make a bequest, distribute all of these assets, including my business, to my heirs, or the trust could be instructed to sell the assets to the heirs or to any other party. Okay, so that's again a lot of background, but that's the background, the deals that we deal with here. let's move to the second section, which is gifting and trusts in action, and talk about how somebody might actually implement some of these things. A type of trust that's used in estate planning, including for business owners, is a testamentary trust. And this is a trust that's set up in a will. It's a provision that's built right into a will document that's subject to the jurisdiction and supervision of the probate court. Some estate plans intentionally want the court to provide accountability and oversight as to what's going on in an estate administration and the ultimate distribution of assets from an estate. The use and enjoyment of trust assets may be delayed until the probate process is concluded. So probate typically takes a year or more. So if you put assets into a testamentary trust, including a business, the benefits of having that business in a family may not be available to the family for some period of time. Further, because this trust doesn't become operative until a person dies, because it's a part of their will, you can't make any gifts to this kind of a trust during your lifetime. Now, you typically don't find these kinds of trusts in cases where you're involved with businesses, but it can happen. These trusts are very useful when minor children are likely to be heirs. So in any case, it's worth noting. A very popular type of trust is a revocable living trust. This is a trust that's set up during a person's lifetime that can be funded either during their lifetime or at the time of their death. Historically, a revocable living trust means I set it up during my lifetime and I transfer ownership of all of my assets to the trust during my lifetime, and I am the trustee and the beneficiary. In Ohio, some practitioners are no longer doing that. They're using an assignment form that basically says I'm going to keep control of my assets and have them titled in my name during my lifetime and assign them to my trust at death. That doesn't work in all jurisdictions. So a lot of people, for instance, who live in Ohio spend some of their time in Florida, or they go back and forth, and the Florida law is different with regard to revocable living trusts and assignments at death. So rule of thumb, if you're going to create a revocable living trust, you just create it and transfer your assets into the trust during your lifetime. These trusts are not subject to the probate process. Therefore, there's limited accountability and no oversight. So you have to trust the trustees and the other parties that you've placed in your estate plan to do all the right things and to be honorable. Again, there's very low accountability here. However, benefits under a trust are immediately available to the beneficiaries. There's no delay in their use and enjoyment of the assets in the trust. Again, they can use and enjoy them immediately following the death of the person who created the trust. Here again, because you are the owner and beneficiary and the trustee of this trust during your lifetime, you can't make gifts to this kind of a trust during your lifetime. But these trusts are usually part and parcel of an estate plan, including the estate plan of a business owner. Now you get into another category of trusts that are called irrevocable trusts or irrevocable trusts. And this is a trust that's set up by a grantor. The person under the tax law is generally referred to as the grantor. And during his or her lifetime, that cannot be revoked or amended. So thus the term irrevocable. So why would anybody do anything that's irrevocable? And again, you only do it when there's a benefit associated with it. Generally, the grantor does not benefit from such a trust. So if you're going to create an irrevocable trust and you're going to put assets in this trust during your lifetime, you generally are doing so because you no longer need the use and enjoyment of those assets and are happy to see other people use them, typically your children. Very often, assets are gifted to such trusts, and the gift rules that I explained earlier would all apply. You can make annual exclusion gifts of $13,000 of either money or property each year to as many people who are beneficiaries. So if you had 4 kids, you could give $42,000 to that trust. Your spouse could join with you, and so on, year after year. And then finally, there is often often a tax benefit associated with the gift. And of course, the tax benefit is I'm getting, among the tax benefits are that I'm getting the asset out of my estate and entirely, including the appreciation. Another popular type of trust is called an irrevocable life insurance trust, or what some people refer to as an ILIT. The purpose of this trust is to ensure the policy proceeds are not included in the insured's taxable estate. So if I'm worth $5 million and I think I'm going to have to pay, my estate's going to have to pay $2 million of estate taxes, I could purchase a $2 million life insurance policy, and when I die, the proceeds could be used to pay the $2 million tax bill, and my heirs get to keep the $5 million of assets. The problem is if I own the life insurance policy, I no longer have a $5 million estate, I have a $7 million estate. So the trick here is to keep the policy out of your taxable estate. If a policy on my life is owned by a trust that I have no control over or no benefit in, then the insurance is not part of my estate. But it can be used to pay my estate taxes, so my heirs get my $5 million estate in its entirety, and the insurance proceeds were the remedy there. So this is very popular in larger estates. One time, or I'm sorry, was there a question?
Yeah, so the trust is the one that actually owns the life insurance.
Yeah, the correct way to set it up is to create the trust and then have the trust be the applicant, owner, and beneficiary of the life insurance policy.
Okay, great, thank you.
Okay. So you can use your one-time $1 million or your $13,000 annual gifts as a way of paying the premiums in this trust. So if my policy costs $10,000 a year, I can, and I had one child, I could be making $10,000 a year gifts to the trust under the $13,000 exclusion that's available for that child, and those premiums those dollars could then be used to pay the premium. In other cases, I might transfer income-producing assets like stocks or bonds into the trust under my lifetime exclusion, or part of it, and then use those proceeds to pay the premium. Insurance proceeds are typically used to pay taxes, expenses. In other cases, the insurance is actually used to pay off debts. There may be obligations that would be a burden certainly to heirs, and you use the insurance to pay them off. And then in other cases, it's used to equalize the estate. I have two kids. I'm going to give one child my business. My other child's a physician, but I want to treat her equally, so I use life insurance proceeds to compensate her. Okay, now we get into a couple of examples of trusts that are fairly complex, and there's a set of rules in the tax law that are called the grantor tax rules, and there's a type of trust that's called a grantor trust. Generally, any trust that passes the tax consequences of trust activities out to the person who established the trust is classified under the code as a grantor trust. So in a sense, it's kind of like an S corporation. Whatever happens that's taxable inside the trust flows out to the grantor, and he or she pays the taxes on those activities. The reason that you want this to happen is that if you allow the trust to pay taxes, you'll pay more taxes. Trusts are in higher tax brackets than individuals are. So generally speaking, you don't want a trust to be a taxpayer, and these grantor rules permit that. Now, the person who established the trust is referred to as the grantor. The grantor typically funds the trust by making annual or lifetime gifts of property or money to the trust. And many of these trusts are used in gift and estate planning. Many of the trusts used in gift and estate planning are in fact grantor trusts. Now, a particular type of grantor trust that's popular, in estate and succession planning is a thing called a GRAT. And a GRAT is basically a grantor retained annuity trust. And basically what that means is it was set up by a grantor who wants the tax consequences to flow out to him or her. And they're going to receive some type of an annuity payment from this particular trust. So these trusts are used to facilitate what are called split interest gifts. Whenever you're looking at a gift from a tax point of view, we get back to this present and future interest business that I talked about a little bit earlier. Let's assume I own an apartment building that's worth $1 million, and it pays me rent of $200,000 a year. The building's appreciating at a fairly hard to believe in this economy, but it's appreciating at a fairly good clip. And I've got maybe a good 20 or 30 years of life expectancy left. By the time I die, it'll be a $3 or $4 million building. It'll be a tax burden associated with its transfer. But so for estate tax reasons, I just as soon give it away, and I've got $1 million exemption that would allow me to do that. But I really need the rent. So how can I accomplish both things? And you can do it through a GRAT. Basically, I make a gift of the $1 million building to the GRAT under my lifetime exclusion, but the trust basically says I'm going to retain an interest in this building, and the interest is I continue to get the rent for whatever period of time that this trust exists, and I state the period of time in the trust. It's going to exist for 5 years, 10 years, 20 years, or whatever I state. So I get to have my cake and eat it too. I get to keep the rent, but I can give the building and the appreciation on the building away to my children. But when I do the tax work on this, it gets even a little bit better, because if I look at this building as having two characteristics, one is rent, which is a present benefit, and appreciation, which is a future benefit, I can split them. So what that means is I can value the building that's valued at $1 million isn't really worth $1 million if I'm going to retain a piece of it. What piece am I going to retain? The rent. So you do a calculation that's prescribed in the Internal Revenue Code, and you determine the present value of the building, which is basically the present value of the future rents. So if the present value of the future rent is $400,000, I subtract 400 from $1 million, and my gift is no longer $1 million, it's $600,000. So I've effectively got $1 million business given away into a trust for the future benefit of my kids, and I only use $600,000 of my lifetime exclusion to put that $1 million business in that trust. So it's a very powerful device from an economic point of view. Again, when you do the math on this, it's pretty impressive. So the beneficiary acquires the trust assets after the grantor, after the period of time expires that was stated in the trust, and then they get the appreciation. You get the appreciation and the taxable value out of your estate. So that's part of the reason it's done. Now, there's a downside to this, and the downside is the grantor has to survive the period of time stated in the trust. So if I say I'm going to collect the rent for 10 years and I die in 5, the whole thing is undone, and it all comes back into my estate. And somebody might say, well, gee, that's no good. Well, the upside is that you're going to live, you set the trust up for a reasonable period of time that you believe that you're going to live. But if you happen to die in the meantime, nothing really changes. There's no penalty and there's no downside to this. You're simply back into the situation you were in prior to making the gift. So again, there's an upside here. You live long enough for this thing to come true. The downside is you die too soon. Now, some clients will say, well, that's no good. I need it to work both ways. And that gets to the next slide, which is an item called an intentionally defective income trust. And this is a very complex arrangement, but again, a powerful economic tool. This is similar to a GRAT in operation, but not in law. Under the law, this is a separate, defined as a separate type of entity. The reason it's called intentionally defective is that the drafting attorney intentionally violates one of the provisions of the tax law, which makes the person who set the trust up, we'll call that person the grantor, the taxpayer. Otherwise, the trust would be the taxpayer. So again, it's not done with deceptively. Everybody, including the IRS, understands what's going on here. There's simply a way to make a trust that would be taxable itself taxable to the person who sent it up and look like and act like a grantor trust. And thus it's called an intentionally defective trust. Here, though, you make some gifts to the trust, but then typically the asset, like the business, is actually sold to the trust under an installment sale. So the interest that you're retaining under the installment sale is the rental income coming back to you to make the installment payments. However, you're not paying any capital gains tax under this type of an arrangement. It's more like a gift, and you're getting the appreciation out of your estate. You're freezing the value at its current price, and if you don't survive the term of the trust, the note ends up in your estate. So it doesn't undo itself as a grat would. So this is another powerful economic device depending upon what it is you're attempting to accomplish. So who are the users of these trusts? Well, again, people with large estates, particularly people who have business interests. These are the clients that we talk to. They have little knowledge of these items and their use or application. So any knowledge that they acquire has to come really through an advisor. They don't think in these terms. They don't read too much about these things and so on. So the use, application, benefit, and implications of such trusts are provided by people who give advice to business owners, typically tax lawyers and CPAs. Such arrangements are complicated and can be costly to set up and to maintain. So that's another consideration. Not only are they complicated and time-consuming, they can, again, be very costly. So you have to take that into consideration as well. And then however, used properly and in the right situation, these devices are powerful. I remember somebody who I worked with once who set up a GRAT. They put a business that was worth like $60 million in it, but because they were in their 30s and they were going to retain an interest in the income distributions from the business. When you do the present value calculation, the present value of a $60 million business when you're in your 30s might be $8 million. So the only gift the present value would be the opposite of that. The $8 million would be the future interest. So the only gift you're making is an $8 million gift as opposed to a $60 million gift. And if you survive that trust, I think in that case it was a 30-year trust, so there's a fairly good likelihood that people would live that long. You get not only a $60 million business frozen, but all the appreciation in that business out of your estate for the next 30 years. So it's incredibly powerful, in the right circumstances. Providers, where do you find these kinds of things? People who are advisors to small business owners and so on, and families are aware of these. The work is typically done by lawyers, the tax work by accountants, and whenever you're making gifts of assets, particularly businesses, you need valuation expertise provided by competent parties as well. And then real quickly, just to bring this to a conclusion, the tax law that we're operating under now, the current law that governs gifts and estates was enacted in 2001, and it was a temporary law. That law will be repealed. The estate tax is repealed next year for 1 year. However, the gift tax is retained even if and when the estate tax is repealed. So we still will have taxable gifts after estate tax repeal next year. Unless Congress acts to create a new law or make the current law permanent, in 2011, the law that existed in 2001 will be reinstated. The gift tax exclusion will be $1 million if that happens. And likewise, the estate tax exclusion would be $1 million also, not the $3.5 million that it is today, and it wouldn't be zero, which it'll be next year. So any planning that's done before Congress takes some steps in this law has to be done with some flexibility and anticipating these events that are likely to happen without Congress intervening. So that's essentially the presentation on gifting and trusts as it relates to business succession and estate planning. So with that, I'll turn it back over to Chris and see if there's any questions.
Thanks, Tom. Excellent presentation.
Thank you.
Get to be a complicated topic very quickly. Any questions out there?
Actually, I do. This is Mel. I am curious, or would like to explore further the use of a GRAT in a business transfer from, let's say, founding family to son. What is the true benefit to the son? Do they get the business in a non-taxable way? Let's say the business is worth $5 million.
Okay.
And the business is put into a GRAT. What happens? What? Just could you,
Yeah. Here, what happens is Dad puts the business into a GRAT. He retains an income interest. So the business is pumping out some dividends or distributions, and Dad continues to collect some or all of that money for the period stated in the GRAT. Let's say it's 10 years. At the end of the 10-year period, typically what happens is the son who's working in the business now gets the business. The trustee distributes the business to the son, and it becomes his property.
At what value, and what are the tax ramifications to the son?
None.
Okay.
There are no tax ramifications. The tax ramification will be that the cost basis, that the father's original cost basis in the business will transfer to the son. There is no stepped-up basis.
Okay, so there is a transfer basis.
Yeah, So if he turns around and sells the business or goes public or something like that, there'll be a larger capital gains tax implication there.
So there's no step up. There's no step up at death of the founder.
Right.
Okay.
Right. But there's no tax that has to be paid. The assets out of the father's estate, so the estate didn't pay any taxes, and there's no tax that the son has to pay as a consequence of getting the distribution from trust.
Okay. Thank you.
You're welcome.
All right. Any other questions? I have a question. How did somebody get the strategy called an intentionally defective income trust past the IRS? How did that name get past them?
Well,
always struck me as an interesting name.
Well, I don't know the legislative history. What happens is, Congress passes a law, and then they send the law over to the regulators and tell them to write rules and regulations, to govern that law. So this is sometimes people would refer to this maybe as a loophole. I don't believe that the Congress or the regulators intended this trust to be used this way. What happens is when laws are passed, talented, clever people in the private sector read these things, and they just figure it out. And they say, well, if I did this and I did that, I'd get this benefit, and that's not addressed in the tax law. So if the IRS has a problem with it, then they intervene. They either they'll do an audit or take it to tax court to try to get a ruling, or they'll issue their own ruling on it. This has been around long enough that it's pretty well established.
Right.
So I think my suspicion is that they drafted some rules that affected somebody who was a particular type of taxpayer that was looking to operate a trust in a certain way, and inadvertently created something that a clever person figures out. I can use this in yet another way that Congress never considered, but it creates these benefits.
Right.
And that's kind of how they emerge.
Right. It just always seemed like an interesting name to me.
Yeah, well, it is. It's kind of a wild name. Intentionally defective. I mean, why would you intentionally defect something? And
right.
And the answer is there's a benefit to it, of course.
Right. Sure. All right. Any other questions? I'm going to ask last time. I really want to thank Tom for coming out. Excellent presentation.
Thank you for having me.
Absolutely. Like I mentioned at the beginning, it's a topic that can quickly get very complicated, and I appreciate the way in which you explained it. Makes it easy for lay people like myself to understand, so I appreciate that.
Thank you.
I want to thank the folks who have attended. Remind everyone that this webinar is being recorded and will be archived up on our website. Probably it may or may not get up today, but it will be up early Monday morning, if not today. So you can look at that, look for that on our website. And I think with that, I will turn off the recording.
Thank you.